Sonny, there's only one word to describe what's happening, and that is panic.
Well, the law of gravity hit Wall Street today, and financial markets around the world, for that matter, as stock prices plunged even more than they did on Black Tuesday of 1929.
Okay, so how can you survive a crash in the financial markets? Well, let's talk about it. This is the Hey Ed YouTube channel. I am your host, moderator, and all-around nice guy, Edward Anderson. I'm not a financial advisor, so do not construe anything that I mentioned in any of my videos as financial advice. Always do your own research before doing anything with your money, and you probably heard by now that the stock market is being roiled, to put it mildly. So in this video, I'm going to give you some tips about how you can survive in this kind of a market environment. Let me start by giving you a little bit of my bona fides on this topic, okay? A lot of you guys know that I worked on Wall Street for a long time. I started out as a stockbroker, then became a trader, and then a trading instructor. And I started on Wall Street in 1987. Now, we had a nice little crash on October 19th, 1987. And it wasn't my first day on the job, but it was the first day of my second week on the job. So within 2 weeks of starting my job on Wall Street, we had one of the biggest crashes in the stock market history. And this clip will show you what my day was like on that day.
I have Exxon at 86 and a quarter 6 months ago. Today it is trading 36 and a half. Mr. Platt. They called it Black Monday. No shit. By 4 p.m., the market had dropped 508 points. The biggest plummet since the crash of '29. I know your family. Fucking shit.
Okay, now since 1987, there have been several other crashes in the stock market. And these can be devastating events for a lot of people. Okay, so remember, the stock market is made up of human beings. Human beings are emotional creatures, so the stock market's never going to be rational. It's always going to be emotion-driven. In the end, there's only one thing that makes anything go up or down in value, and that's buying pressure. If there are more buyers than sellers, it goes up. More sellers than buyers, it goes down, period, end of story. Why people are buying and selling really comes down to three different emotions. There are three emotions that drive the market: fear, complacency, and greed. And of those three emotions, the dominant emotion is fear. And that's why, statistically speaking, stocks go down 4 times faster than they go up. Okay, now in this video, you're going to hear me use the term stocks, but this principle applies across all asset classes, including the stock market as a whole, in the financial markets as a whole. And there is a succession in the progression of emotions in the market. Okay, so it starts with optimism, then that turns into excitement, and then you get the thrill, then you get the euphoria, then anxiety, denial, fear, desperation, panic, and then the cycle starts all over again. So what we want to do is take advantage of those emotions. Now, back in 1987, we did not have the technology that we have today. Okay, back then, if somebody wanted to buy or sell a stock, they would have to call a broker, me, and I would have to literally write out a ticket, and it would be a carbon copy ticket, right? And I have to put in, buy, sell, list the stock, the price they want. Is it a limit order or a good to cancel order? And then I would literally walk that ticket over to a girl whose job it was to call in that ticket. And she would call that order in to some guy in the back office, and then they would literally physically execute the order. Then I get the confirmation. There was none of this, online confirmation stuff. You didn't have online trading capabilities back then. I mean, back in 1987, the stock market was just starting to get computerized, and the world was just starting to get connected globally. But there was none of this, day trading capabilities, or I mean, listen. If you're out there trading today, or if you're doing any kind of, online buying and selling, you are spoiled. And these days, we even have the advent of high-frequency trading algorithms and AI trading software. This is a brave new world. But the three emotions that still dominate the market and dictate the market are fear, complacency, and greed. Now, because of the speed and severity of the sell-off over the past couple of trading days, I am expecting a pushback rally imminently. In the next 1 or 2 trading days, there is going to be a pushback rally. It might be kind of impressive. And that's why on Friday I did a video telling you guys about the options that I bought, the call options that I bought. But because of all the technical damage that was done in the market the past couple of trading days. Any kind of rally is going to be used as a selling opportunity by people who want to get out. They're fearful and they're just waiting for a bounce to get out. That's what's going to happen. Because, think of it like this. Imagine that you are an amateur and you get into a ring with a professional prize fighter and you get hit in the face full on by that professional boxer. You are going down. Now, you might stumble a few times and make a noble attempt to get up, and that's what rallies are, right? They're noble attempts, to get off the mat. But you are going down for the count. But I think the market here is going to go down quite a bit more, but it's not going to get there in a straight line. Now, another thing that you have to factor in, and that's the idea of forced margin selling. There's a lot of selling going on the streets, and the computers are doing automatically because of margin calls. And I'll make a prediction here that over the next week or two, you're going to start hearing stories about hedge funds, maybe even some prominent hedge funds, who are out of business. They've gotten destroyed. They are toast. They are gone. That's because these guys are greedy. They're not as smart as you think they are, I promise you. Don't be impressed by some guy just because he works for a hedge fund, okay? These guys get way too much credit than they deserve. But these hedge funds, they often use a lot of margin in order to maximize their gains. Well, when you have a lot of margin going on, that means you own stocks, on credit, right? And when your stock goes against you, you get a margin call. And in the old days, I would call you and say, hey, dude, you got a margin call. You got 3 days to send some fresh money into your account to meet the margin call, or I can just sell your stock. These days, they typically don't give that courtesy. The computer will just sell that position for you. Boom, it's gone. And that's what a lot of the downward price action on Friday was. It was forced computerized margin selling. And not only that, but the regular retail investor out there and the amateur trader, and even the institutional traders, they'll have computerized stops in place. So when those stops are taken out, the computer sells the position. And again, we did not have that feature in 1987. So the speed and severity of movements these days are much larger because of technology than it was back in 1987. Okay, so for the sake of posterity, today is April 6, 2025, and let's do a little reminder here of what happened on Friday. Here's the big stick. Now, I'm not going to rehash all the support levels that I covered in my previous several videos. I don't want to replow old ground, but let's go back to the one-year chart. Okay, now you can't really kind of see it in this, but look at the damage that has been done to the market in just the past 2 days. And by the way, if you don't see it in here, there is a textbook head and shoulders pattern here, and 42,000 was the neckline. This is not fancy stuff, guys. I put it up. This stuff works. They're very simple patterns. They're very easy to read, and you have to believe them. You have to trust what you're seeing. Anyway, but because we are right at this, 38,000 level, in the market, that's why I am anticipating a pushback rally. But let's go back 2 years to look at the potential downside in this market. Okay, the real support level on this market is down here at 32,000. Now, I'm not saying that we're going to get there, but that is the potential. Now, listen, a lot of people are calling this a black swan event. As a matter of fact, I was thinking about making that the title of this video, How to Survive a Black Swan Event. But really, this is not a black swan event. A black swan event refers to an unexpected event, something that no one saw coming. But the truth is, this notion of these tariffs, roiling the markets, this is the worst kept secret in, market history. Okay, people have seen this coming for months. So this is not an unexpected event. And by the way, the tariffs are just a fall guy. Okay, it's just an excuse. It's just an excuse they use for other things that the market should not have been trading at the levels that we are at. We are in a bubble, and we are in the mother of all bubbles, and that's why this market sell-off could turn into the mother of all sell-offs. It could make 1987, 2008 look like a picnic because the bubble is so extreme. Now, for those of you, by the way, who think that Trump doesn't care about this, I promise you, he knows what's going on. And I saw a post recently that said, if the president can get the 10-year below 3.7% without a Federal Reserve cut or triggering a recession, economists will write books for decades. Well, guess where the 10-year bond is right now? It's 3.8. So start writing your columns, start writing your history books. So why is a 10-year bond yield plummeting? Well, in times of severe stress or anxiety or fear, people move from risk assets to perceived safe assets. namely, U.S. government bonds. So bonds have been going up while the stock market has been going down. But remember, with bonds, there's a teeter-totter effect, okay? So when the price of bonds go up, the yield of the bonds go down. So that's what's going on. So this huge flight into bonds is what's bringing interest rates down. So that, mortgage rates, other interest rates could come down just because of the nature of the markets. And of course, the Federal Reserve's hand is going to be forced, and they're going to be made to lower interest rates because the markets are going to lead the Federal Reserve by the nose to lower interest rates. And, when that announcement is made by the Federal Reserve officially that, what, we're cutting interest rates, the market's probably going to have a nice rally on that news. I don't think it's going to have too much of a lasting effect, but there will be a very tradable event when that day comes around. Okay, so this is a topic that I've got a lot to say on, but, again, I want to respect your time. So let's cut to the chase. What should you be doing right now if you are in the stock market? Well, first, let me remind you of what the mantra is on this channel. Get your money out of the bank, acquire some gold and silver, and establish streams of passive recurring income. But more specifically, regarding the stock market and the crypto markets for that matter, since I believe the markets are going to go quite a bit lower after having a rally. Okay, I think we are going to get a rally, but after that, it's going to roll over and go down more. And I want to emphasize that this is not financial advice, okay? I'm not a financial advisor, okay? So I'm just a dude on YouTube, okay? But these are some things that you could do. First of all, if you own anything on margin, reduce or eliminate your margin. And number two, you might want to consider moving your positions into cash. When we get this next big pushback rally, you might want to use that to go to cash. Now, you're going to say, well, Ed, I'm still down a lot. Listen. There's a saying amongst traders. The first loss you take is the best loss you take. Okay, just cut your losses and move on. The market right now is where it was this time last year. So the market in the past 2 months has lost a year's worth of gains. But when you take another look at that 2-year chart that I showed you, the downside potential is huge. Now, of course, one option is that you don't do anything. You just hold on to your positions and suck it up and tough it out. Number 3. Start learning how to think like a trader. This is a trader's market. It's not an investor's market. Now, I'm not necessarily saying that you have to become a day trader, okay? That's not what trading means. There are plenty of professional and institutional traders out there who will hold on to a position for an indefinite period of time. So the difference between trader and investor is one of philosophy. That's why the term investing has negative connotations to me. For me, it's a dirty word because investing implies hopium. Okay, you buy and you hold on because that's what Wall Street, ironically, has been brainwashing you to do your entire life. They brainwash you into never selling because they don't want you to pull your money out of their accounts. They make money on your money, man. So they're afraid that if you sell, they're never going to see you again. So they never want you to sell. Meanwhile, I promise you, they are buying and selling. They are trading, but they don't want you to do it. So an investor will buy and hold on to something because they have faith for some reason that whatever they're in is eventually going to work out. All they have to do is hold on long enough, right? Meanwhile, your assets could go down 50%, before the bottom is in. I'm not saying that's going to happen, but it has happened, and that absolutely could happen, which means from that level, your positions would have to double just to get back to break even. And how long could that take? Okay, you could have left years worth of productive growth in your portfolio if you're just a little bit proactive. Do something simple like put in stop orders, put a 10% stop limit in on all of your stocks to protect you on the downside. Yeah, take your little loss. Maybe by then you'll be locking in a profit because your stock has gone up more than 10%. Just protect yourself to the downside. The formula for making money in the market is pretty simple. Keep your losses small and let your winners run. If you're in a stock and it goes up and up and up, just keep raising your stop. Just stair-step your stops up. And another thing you could do is, if you don't want to take the time to learn how to trade or to even think like a trader, and you don't have the skill sets to trade, you don't have the discipline to trade, I've got programs that can do it for you. Good professional traders with track records that can trade it for you. Now, I can't mention them specifically in a YouTube video because there are rules against it, but if you want to learn about them, shoot me an email. My email is in the description below, and I will send you a link to my Hey Ed WhatsApp group, and you will learn about these programs. So, Just farm it out. Let somebody else worry about making those kind of trading decisions. I mean, personally, I am loving the volatility in this market because volatility is a trader's best friend. But if you don't want to be bothered with that, again, check in with me. Send me an email. I'll send you a link to my WhatsApp group and we will get you set up. If you are a veteran to my channel and you've been paying attention to what I've been saying and you've been putting some of my ideas in action, you are loving this. Everything is coming true. And I'm sure that this Christmas, I'm going to get fruit baskets from all you guys, right? Because actually, I'm very good at this stuff. And if you just go back, all my videos are up, okay? You can go back, I don't know how many years and watch my videos. You'll see how I'm right almost all the time. Please like and subscribe. Ed Anderson, live from Minnesota, signing out.
Copy that.